So welcome everybody. It is now 11 a.m. Central Time. Um, my name is Steve Misic. I am an instructor for the Online Trading Academy. I live in Chicago, Illinois. Welcome to everybody that's attending from all over the world. This is part 5 of the current market cycle from April of 2012 to today in the asset known as the dollar versus the Japanese yen. Okay. And on the FX Street website, you can see that I'm doing a webinar today at 11 a.m. Central Time. And at 5 a.m. Central Time tomorrow, you'll get a chance to actually listen to Sam Seiden doing a webinar. All right. And Sam Seiden, of course, is my personal mentor. I've known Sam now for quite a few years. I met Sam through a friend of a friend, and he was kind enough to introduce me to Sam. I was learning how to trade, and I was looking for somebody who could teach me how to trade. I've always been somebody that's responded very well to one-on-one personal mentorship, and I've had other mentors in other areas of my life in the past. It just seems to be something that works for me. When Sam became an instructor at the Online Trading Academy, and eventually he became the head of the Online Trading Academy's education, he asked me to come along, and so that's why I'm here. All right. FX Street has asked me to do webinars, and what I'm doing is the market cycle in the dollar versus the Japanese yen. And the market cycle in the dollar versus the Japanese yen is part of what we call our Online Trading Academy core strategy. The Online Trading Academy core strategy basically is the demand and supply that Sam discovered how to read on a price chart from his days trading on the trading floor in Chicago, ironically in the Japanese yen pit, by the way, in the currency futures markets. And Sam discovered that institutions placed large orders to buy and sell assets, and whenever price came to where there was large orders to buy and sell were, the market would react. And that was pretty much what Sam figured out. And then what Sam figured out, which was even more amazing, is he viewed that picture on a price chart. What he ended up doing was printing out something called a price chart, what we're going to look at here shortly. And through the use of colored pencils, he was able to actually train his eyes to find the areas where these institutional orders to buy and sell were, rendering the job that he was doing at the Chicago Mercantile Exchange not necessary anymore. So Sam left the floor and began trading his own account, trading accounts for other people. And of course, it's now a patented trading strategy. All right. And Sam will go into the details on how to locate levels tomorrow in great detail, as he always does, for everybody that's going to attend those sessions or watch the recording. What I discovered was that the markets tend to also trend. And for somebody that happens to be a floor trader looking to make a living every day from the foreign exchange markets or from any other market, you really wouldn't be as concerned about the long-term trend unless it happened to be in an asset that actually did trend. All right. So if you were somebody that was going to trade for daily income, as we like to say, you would probably be just concerned with looking for demand and supply levels on very small time frame charts. Your goal would be to get into a trade during that day and close that position before the end of the trading day. So for that style of trading, daily income, you'd use very, very small time frame charts, right? From my perspective, as what I call a longer-term trader looking for longer-term income and wealth, I very much believe that markets also trend, and that trend is an important factor, okay? And my best explanation of trend is markets are going to trade between areas of demand and supply until either the demand levels are absorbed and then prices will go lower, or the supply levels are absorbed and then prices will go higher. Okay, so what you're looking at, hopefully everybody can see the chart of this dollar versus the Japanese yen, which is a weekly chart. And this is from the week ending 10/2 of last year. This is where we left off. Okay. And if you can see that, do me a favor, type in the chat a Y for yes, an N for no, so that I know that we're viewing the markets before I go too much farther. All right, great, Carlos. Thanks. All right. Moving on to the next page where we left off at, actually. On the weekly chart, what you see is a picture of a market that's very much trending, but it seems to have run into an area of supply at this point in October 9th of last year between 99.24 and 101.52. And because we ran into that area of supply, the markets actually stalled, the trend stalled, and the markets began to trend sideways, and they were trending sideways into that supply level, going all the way back to August and September of last year. Okay, there's a weekly demand level at 94.43 below current price, which is where the market actually bottomed in late June, early July of last year. And now, whichever one of these two levels, either the demand level below current price or the supply level that we're looking at above current price, whichever one of those goes away, would be the next trend move for the dollar versus the yen. And until one of those goes away, we believe at this point in time that the markets are probably just going to continue to trade sideways, with institutions looking to buy dollar yen at 94.43 and sell dollar yen at 99.24. Okay. We move to the daily chart next on 10/9, and on 10/9, the market actually came down to an area of our chart here of demand, which we identified the origin of a pretty strong rally from the week of August 12. And price came down to that level on that trading day on the 9th, and it bottomed in that level, and it began to once again bounce out of the demand level. All right, so the markets began to trend once again a little bit higher. And at the same time, I've been tracking the Nikkei 225, which is Japan's stock market. And the Nikkei 225 also began to reverse a prior downtrend and started to trend higher also. Right? Okay. All right. Now, on 10/12, the dollar yen reached an area on the daily chart where it had fallen between 98.42 and 99.13. So anyone that would be long from the 96.70 area would probably be looking to take some profits at this area, because one of our targets every time we take a trade using opposing demand and supply levels is always the opposing level. Okay. So I have a question from MRC at 102.54. Why is there a level? Any place that I have lines on the charts are going to be areas where prices have rallied in the past, which is where institutions have unfilled orders to buy, and where prices have fallen in the past, which is where institutions have unfilled orders to sell. So when we get back to that weekly chart, which we probably will in a couple of slides here, we'll take a look at that area at 102 once again. Definitely the origin of a drop back in July of last year. And that would represent where institutions were sellers on rallies. Okay. So the area that we have right here, where the supply level is at 102, is part of actually a supply level from the past, an older supply level from the past. And at that point in time, above current price are going to be many areas of supply above current price that are going to be tested whenever a market rallies. As a matter of fact, part of the reason why you have what we call normal profit taking in a bull market, which would mean selling, part of the reason you have that selling is because price is going to rally into an area in the past where prices have fallen, And once again, if there are still institutional orders to sell at that price level, then what will happen is this price will fall once it reaches that area. Okay. Give me 1 second. I'm getting a couple of. All right. Sorry about that, folks. Just wanted to kind of quiet those alerts. All right. So on the week of 10/16, now we have the dollar versus the yen bouncing off of that daily demand level. Once again, getting close to testing the supply level on the weekly chart between 99.24 and 102.54. Okay. And as we can see on this chart, I mentioned to the students that were viewing the blog that I do every week, which is where this comes from. I mentioned to those students that there was the possibility of a technical analysis chart pattern known as an ascending triangle. And an ascending triangle is something that you'll find in most of the textbooks. The area above 160 would be the breakout point for that technical pattern. Each week we had higher lows, and therefore we were finding buyers at higher and higher prices. However, for the market to continue higher, it would have to break above a area which was a previous high at 162. We talk about technical patterns in our classes, but when we talk about technical patterns in our classes, we're basically talking to the students about what their competition is trained to look for. And what I mentioned to the readers of the blog in that particular week was that technical patterns such as breakouts that are into areas where large orders to sell are waiting generally are going to fail, all right? But at the same time, I was doing a radio interview on the Power Trading Radio Show with Merlin Rothfeld the following week. And one of the students sent in an email question about the possibility of a breakout of another pattern called a symmetrical triangle. So I addressed the pattern, and I mentioned to the students that one of the things about technical analysis that you're always going to find is one technician is going to see one technical chart pattern, and another technician is going to see another technical chart pattern. And of course, that basically means that, yes, there was the possibility in the week of 11/5/13 on the weekly chart, there was the possibility that a breakout above a downsloping trend line on the weekly chart, which would be the symmetrical triangle pattern, would be just as valid as the breakout of the ascending triangle pattern. And that was a good catch by that particular student. So, of course, he was asking if it was okay, once again, to buy the breakout. And I would always mention to anybody that listens to what we do and understands the way that we teach, we never recommend buying breakouts into supply levels or selling breaks of support into demand, because generally that's going to be where the market fails. All right. And so my answer to the question was, if there was a pullback to some kind of demand level prior to the breakout, where you could have an entry, stop, and target and define your risk on a trade, then the trade would make sense. But for me to condone buying a breakout into an area which had been supplied for the last 4 months really wouldn't make a lot of sense. But one thing I want to point out is you look at this picture of this weekly chart, the more times price comes up to a level where there's orders to sell, the more opportunities there are for those orders to be filled. And if all the orders are filled, then the market will rally through and it will seek orders at higher prices. So there is a chance that a momentum trader could have a successful outcome. On this daily chart on 11/5 of the dollar yen, you're going to notice that a new demand level had formed just above the level that we had identified at 96.70. There was now a level at 97.37. And price was still struggling, trying to get through the 98.42 supply level. All right. And that supply level had held the market back from the middle of October now, almost to the middle of November. Okay. So the following week on 11/9, the price begins to rally through the supply level on the weekly chart. It's breaking above the downsloping trend line for the potential breakout to be a success, the symmetrical triangle breakout. Price still has a way to go before it's going to get to where the breakout of the ascending triangle is. But notice that before the breakout, price managed to fall down to the area on the daily chart between 97.73 and 97.37, giving anybody that did want to buy a breakout a much lower risk opportunity long trade by buying a pullback to a demand level prior to the actual breaking of that prior supply level on the weekly chart. Okay. So as I mentioned, and I wasn't sure that would happen, obviously you identify the areas where you believe prices are going to turn. You identify the supply levels and demand levels. But then you need the market to cooperate and come actually down to the areas where those orders are. You just have to be prepared that if that's what happens, you're going to take a trade. So if you wanted a long trade at 97.73 with fairly low risk, the price came down to the level and a day later rallied all the way back up to the higher supply level between 99.32 and 99.97. So question from Carlos is, breakout trades often fail. However, do you believe that when those areas are tested multiple times, the price action on its pullback may give us info on a potential confirmation of a potential trade? Well, once again, Carlos, good question. What we teach our students to look for are, first of all, areas of demand below current price, areas of supply above current price. We believe that areas where prices have fallen in the past are going to contain unfilled institutional sell orders. And, of course, areas where prices have rallied in the past have demand. And what you can see is levels tend to form on top of other levels, which is what's been happening here. We had a level at 96.70. We had another level form above that at 97.37. We actually had another level form above that at 97.73. And of course, once price finished with the supply between 99.42 and 98.42 and 99.10, it rallied right up into the next supply level at 99.32, where once again, there were sellers. All right. Okay. So what I call this price action is actually range extension. The market has been finding buyers now in this area near 97, has been finding sellers in the area near 99. And now we're pushing through on the following week, the week of 11/13, and we're pushing into the daily and weekly supply levels once again. And the symmetrical triangle trader, if they did take that breakout, is beginning to experience a profit on this trade. And of course, if you're beginning to experience a profit on the trade, you would probably, as a momentum trader, want to be protective of that profit. One suggestion might be, is if you are a breakout trader, there's no harm in placing your stop loss below the week. If you're trading this breakout pattern on the weekly chart, below the weekly candle. And of course, if it retraces and falls back and goes back inside the range, you'll be able to take either a small loss or a small win on that game. All right. But if you hang in there, and anybody that did hang in there began to get rewarded. So price now manages to rally through the 99.10 to 99.79 supply level. And it's beginning to move its way through that daily supply level. And it's created a little tiny daily demand level between 99.17 and 98.88. So another suggestion for the breakout trader would be to put a stop loss below this demand level at 98.88. And of course, if that demand level holds, there's a very good possibility that the trader can end up with a profitable trade. Okay. So the markets are once again beginning to get bullish. And on the Nikkei 225, which is the Japanese stock market, which again I am following every week on my blog, the Nikkei managed to rally through a major supply level between 14,791 and 15,086. And what has been happening is whenever there's a rally in the Japanese stock market, it will translate to a rally in the currencies that trade against the yen. So in other words, there'll be weakness in the yen if there's strength in the Japanese stock market. And at this point, that's what's happening. Okay, so the following week, the week of 11/20, the market now has clearly closed above what we call the proximal line of our weekly supply zone. We've actually closed inside the level. And we're just about to break out above the 160 area where I had the ascending triangle breakout point. Now, anybody that's long from an entry near 97, of course, is in profit at this point by about 200 pips. And anybody that is profitable in that trade would also want to protect themselves just in case this breakout trade fails. All right. But I left these lines on the charts because I was getting some discussions from the students that were reading my blog about the possibility of a momentum trade. Some people like to buy momentum, all right? And we generally encourage students to buy pullbacks to demand as a way to join the trend with a lot less risk, right? Okay. And now on the daily chart, on 11/20, we actually have another two levels of demand between 99.59 and 98.88. So at this point, we're tackling a supply level near 140, and that supply level on the daily chart went all the way up to 191. Okay. So on the Nikkei chart, the rally in the Nikkei also had stalled now, and it had stalled for about 4 days or so. So the market was taking a breather after a pretty strong move. However, the next supply level for the Nikkei was about another couple of 100 points higher. So really nothing to trade short against. I've seen the market do this several times, and one of the chart patterns that's in your technical analysis books is something called a bull flag, and the pattern on the Nikkei would resemble what a bull flag would look like, a long flagpole with some days that you had lower highs and lower lows, which is the shape of the flag. Most likely the next breakout, especially if there's room for a breakout, would be to the upside, and this market would continue until it reached the next major level of supply above. So now the ascending triangle breakout on the weekly chart on the week of 11/26 has now successfully happened, and anybody that was trading the breakout above the ascending triangle breakout point of 100.660 would also be profitable on the trade, but not by much. And unfortunately, the trade ran right into another supply level on the weekly chart between 101.84 and 103.72. So what we teach our students in our classes is you can, if you're a breakout trader, protect yourself from the failure of a breakout because breakouts do fail, and they fail quite often. So you can protect yourself from that breakout. And one idea would be to either go to a smaller time frame chart and trail your stop loss, which would protect your profit on that trade. Okay. But now both the symmetrical triangle trader and the ascending triangle trader are profitable. And of course, I'm kind of keeping track of that for the students that are watching that happen on their charts, because it is a technical pattern that occasionally will work. And some people who like to trade those patterns would probably want to protect themselves if they possibly could from any kind of weakness. as price has reached the level. And on the following week, the week ending 11/27 at this point, price is in the level. It is at this point trying to absorb the supply between that area. And on 11/26 on the daily chart, you can see that there were several smaller time frame demand levels on this daily chart, with the closest one at this point being at 100.23, down to about 99.59. And below that was another level down to about 98.81. Okay. So the breakouts through the supply levels had worked out pretty good, and we were now retesting an area of supply which was much, much older. Okay. And that level again from supply was from around June, July of that year. Okay. So now we go to the weekly chart in December. And one thing I always like to tell students about trading around the holidays, December, Christmas holidays, Thanksgiving holidays here in the States, trading can be a lot thinner. And because trading is a lot thinner, there's the potential for breakouts such as the one that you're seeing happening here to work out a little bit better, because not every one of the banks that is normally trading during this period of time is working. So the markets are a little bit thin, and therefore you can have exaggerated moves, especially around bank holidays and especially around major holidays such as Thanksgiving here in the States and, of course, Christmas. So we're pushing deeper into the supply level now, the week ending in December, the first week in December. And on the daily chart, we are in a daily supply level, which had formed due to rising yields on Japanese government bonds, which we call JGBs. Okay. So we're in this supply level on the daily chart. It had been tested on the way down in late May, early June of last year. And now we're testing it again for the second time. Of course, we need to push above 103.73 at this point for us to make new 2014 highs, or 2013 highs, I'm sorry. And of course, the next supply level, as you can see above current price, I've mapped out at around 105.28. So being as how it was the Christmas holidays and being as how trading was thin, you also had the Nikkei 225 working on the supply level between 15,715 and 16,266. And on its way up, it had created a daily demand level between 15,222 and 15,026. So that meant that the Nikkei 225 and the dollar-yen pair were making new highs for the year. And on this particular daily chart, which is kind of scrunched up here a little bit, notice that we did rally above the supply level. We had broken through the back end of the supply level, and we are now trading above 104 at this point, meaning that a quick look at the weekly chart would show that, we're very much inside our supply level now for the third week in a row. We are absorbing the supply, both the ascending triangle pattern breakout and the breakout from the symmetrical triangle are very successful at this point. And in the weeks that followed, the market did trade sideways inside this level for another week, around the week of 12/18 last year. And this is the pattern that happens whenever a market reaches an area where there is supply. The buyers and sellers go back into equilibrium. If you absorb the supply, of course, the market will rally higher. If, of course, the number of buyers drops to zero, you expect the price to fall. If you are a momentum trader, you don't like this price action. You are not making higher highs and higher lows at this point. On that week on 12/18, at least on Wednesday of that week, which is when I do the blog, you'll notice that we are making a lower high for the week, which of course would be a bearish chart pattern. However, because it was the holiday week, the weakness that we had ended up being a buying opportunity to an area of demand on the daily chart. That 101.44 area of demand on the daily chart was actually a buying opportunity. And the following week, as we're getting ready to end the year last year, the market poked its head above the old weekly supply level, created a new weekly demand level. And at that point, the breakout is to the upside. And generally when that happens, we look for higher prices to continue. We expect the market to continue to trend until it reaches another major area of supply overhead. And of course, we are making weekly areas of demand as we go higher. 103.20 down to 102.14 is the first area of weekly demand below current price at this point. And that meant that if there was any kind of weakness, it would be possible for the market to find buyers in that level. But remember now, at this point, the markets are breaking out to new highs. The trading volume is very thin. We are creating daily demand levels as we go. And we have one now between 103.004 and 102.495, right? And we are looking as though we were going to push a little higher. And we probably are going to find sellers when we do push higher and we reach the area of supply around 105. And so the last couple of trading days of 2013 finds the market clearly above the old supply level. And now it's managed to rally as high as 105.15 on 12/28. And it's at that point on the high of the week. All right. So I have a couple of questions here. Carlos in New York says that he shorted on the 4-hour chart at 102.95, targeting 100. But sometimes one can sit in a dollar-yen trade forever to partial profits, move stop loss to break even. However, beginning to think that it might not hit the final target. Yeah, we are in the end of December on this presentation, moving into 2014 finally. It's been 5 months of us actually doing this presentation. And the reason I'm doing it again is as a way to kind of show you what we see, what we teach our students to look for. And of course, this is just one of the assets that we teach students to look for, the dollar versus the yen, as a matter of fact. And we will get into the area where we talk about what's happening in the now, in the here and now, as soon as we've done the last presentation for this series, all right? And Igor says, hi, the dollar is in supply on the 1-hour chart. The pound has formed a drop base rally demand on a 5-minute chart. Do you think it's a good buy for a short-term income trade? Okay, great question. If you are a short-term income trader, the only negative you have right now would be the time of the day to take the trade, with the London markets closed and the U.S. being the only market that's open. 5-minute supply levels and demand levels are a little bit on the suspect side because there's just not a lot of liquidity. So you could take that trade. Just make sure you use a stop loss and then you have a target that's at least 2 to 3 times what you're risking in a trade. That's what the trading is all about. Okay. So here we are finally at 12/31/13 on the weekly chart of the dollar versus the yen on New Year's Eve of last year. And what we have is a market that is clearly now broken out to the upside and is just about to approach the next supply level at a 105 above current price, 105.50, somewhere in that area. The market is on the highs of the year at that point in time. All right. It's up 36.67% since the October 2012 bottom. All right. So let's move into January, finally, of 2014. And in January of 2014, we begin with my presentation sticking on, unfortunately. Sorry about that. We begin with looking at a chart on 1231 of the Nikkei. So the Nikkei had rallied into supply at that time between 15,715 and 16,266 and was falling from the level, which, of course, is not a good sign for a continuation of the rally in the dollar versus the yen. On 1-2, the Nikkei actually started to fall closer and closer to the level of demand between 16,000 and 15,830. Okay. And of course, on the dollar versus the yen chart, on the daily chart, price had fallen from our supply level, which was very close to 105.50, and it actually came down to a demand level at 104.27, which formed actually on the rally to the highs of the year. So this little base before this rally was actually the first demand level below current price. And now we've got a situation where the dollar versus the yen is attacking weekly supply. And because the trend is bullish, there are buyers on this pullback at this 104.27 area, as evidenced by this bullish reversal candle on 1-3. But what we always teach our students to do is to try to use demand and supply levels that give you profit margins. In other words, there has to be a distance between a demand level and a supply level for you to take a trade. So when I take my daily chart on January 3rd down to a 60-minute chart, I notice that there is a nice little demand level, the origin of a rally with a gap. And the pullback to that level was a buying opportunity, with, again, the prior highs now becoming some kind of a supply level. Okay. And now we look at the monthly chart. It is the first week of January, with the monthly chart showing, of course, that the dollar has been in a bear market for the past 40 years against the Japanese yen. So currently what we're just having is what I call a cyclical bull market rally and a longer-term secular bear. Who knows how long it's going to last? It could last a long time, especially if the Bank of Japan, which is printing money at a rate that's about 10 times the rate of the U.S. central bank, continues to print. This counter-trend rally, this short covering rally, whatever you want to call it, has the potential for much higher prices if it wants to continue. But of course, for that to happen, everything has to line up correctly. And so in the first week of January, we're experiencing a little bit of selling below a weekly supply level near 105. And on the daily chart, we now have come down to our demand level once again on 1.4. We're bouncing out of our demand level on the daily chart. As for the Nikkei 225 is also testing a demand level in approximately the 1,600 area, or 16,000 area actually. But now you have a supply level overhead between 16,345 and 16,453, which is just below the high, the prior highs that were set at the end of 2013. So now the situation is, which one of the two levels is going to go away first? And of course, if the supply level goes away, the Nikkei would continue to rally higher. But we are inside of some higher time frame weekly supply. And at that point in time, it was looking like the Nikkei was struggling. The dollar versus the yen the following week had a nice little rally. The first week completed for 2014. And on the daily chart, we managed to bounce out of that daily level between 104.27 and 103.76. We actually had 1, 2, 3 visits to the level. The first visit was a bullish reversal candle. The next day was a sell-off back into the level. And then we had a strong rally for the next 2 days after that. So on 1-8, we're rallying out of our demand zone. Okay. And on the 60-minute chart, which you'll see more of as we get closer to current price, to where we are today, I've identified that demand level. And I've also identified a 60-minute supply level now near the prior highs of these. Okay. Question came in about the moving averages that I use. A 10-period moving average, a 30-period moving average, and a 200-period moving average. And since I'm on a 60-minute chart, those moving averages are kind of all bunched up on top of each other. The moving averages are trade station moving averages. They are weighted, meaning that they give a lot more weight to current price. They are moving averages that I've used for my trading now for, I don't know, since I started using TradeStation many years ago. And I got those moving averages from the analysis that I learned about the market cycle in a book called Secrets for Profiting in Bull and Bear Markets, which was written in 1988 by a gentleman named Stan Weinstein here in the States. So these are the moving averages that he used in that book. I've continued to use them because I believe his methodology of trend recognition combined with Sam Seiden's methodology of supply and demand is the way markets work. And so I'm not really using the moving averages extensively on any of the charts except for the weekly chart. Okay. And a weighted moving average actually is more sensitive than an exponential moving average because the exponential moving average has one calculation to smooth out the moving average. And this moving average is actually more raw data. So it's actually a little bit more sensitive. All right, we're going to wrap it up here in about 3 minutes. And we are going to do our best to move along here in January of this year. Okay. On 1/8, you'll notice the Nikkei also has been visiting this daily demand level between 16,000 and 15,830. Hasn't yet visited the supply level overhead. And the dollar versus the Japanese yen, likewise, visiting the level of demand. Okay, the weekly chart of the Nikkei shows that there is a weekly demand level between 15,708 and 15,163. And this is really important at this point for both the dollar versus the yen and the Nikkei. Now you have weekly demand and supply so close to each other that there's going to be a failure of one of either level. And obviously, if the demand level fails, you'll start a bearish trend in the opposite direction of the current trend. And that's the same thing for the dollar versus the yen, because if we have a failure of our weekly and daily demand levels, you will see the price begin to visit lower levels as the market trends lower. So on 1/11/14, 74,000 non-farm payroll jobs were created in the U.S., and this was a perfect excuse for the institutions to rally price of the dollar yen up into that supply level near the prior highs of the year and back down on the same day into the demand level. But now we've penetrated 100% of that demand level, and that means that prices are likely to fall from that area. And notice on the 60-minute chart, the price actually touched the level between 105.32 during the release of the economic data, and then reversed and fell sharply to the very bottom of the daily demand level, which now you see what it looks like on a 60-minute chart, and started to rally a little bit out of that level. Okay. The Nikkei penetrated the backside of the demand level also, which is bearish. That's an indication that prices want to go lower. And as we leave our session for today, we notice that the dollar versus the yen bottomed at this point in the week of January 15th in the weekly demand level between 103.20 and 102.14. Okay. And we rallied a little bit out of that level on 115. And of course, this is the daily chart. Notice that the market had tested the lower level of demand between 103.004 and 102.495, and it had a very sharp rally for the next 2 days. So price has taken out the first area of demand, the 104.27, 103.76 level, fallen down to the next level of demand, bounced out of that level once again. Okay. But now at this point, notice the lower highs in this daily chart, and notice the possibility that instead of buying pullbacks, institutions may actually switch up to selling rallies. All right. So it's January 15th is where we're going to leave session number 5 of this webinar series. Okay. January 15th finds the Nikkei testing weekly demand, the dollar versus the Japanese yen testing weekly demand, and also the Nikkei testing daily demand in approximately the same place and bouncing higher. So when we pick up the next session, which will be next month in June, we will pick up week ending January 22nd, 14. All right. And last question I see here from Igor, you're short the euro yen. Where would you put the target? Here's the picture. I wish I could comment on that, my friend, but unfortunately, let me see if I can bring the picture up. So if you're short, probably the first place to get a target would be where your Fibonacci's are on this particular chart, the lower Fibonacci, and obviously the next area below there where you've highlighted the area would be target number 2. All right. Very nice. So with that, I think what we're going to do is we're going to call it a day. Thanks to all who have attended. Thanks to all from FX Street for inviting me for this series of webinars. Hopefully they're helpful for you. Okay. And we will pick up with session number 6 in January of this year, and hopefully work our way towards May and catch up to where current price is. Have a great day. Be sure to attend tomorrow's webinar with Sam Seiden. See you next time. Bye.